Hello Maverick traders, this is Imri and welcome back to this educational class on identifying corrective waves, and today we'll be taking a look at a very specific corrective pattern known as the zigzag. Now, the foundation for my own personal trading plan is Elliott Wave theory, and within the Elliott Wave family of market structures, there are a fixed number of core patterns. So we took a look at impulse waves the other week. This week we're taking a look at the family of corrective waves. There are more corrective wave patterns than there are impulsive patterns, right? Which is excellent news for us traders, because when we're capturing an impulsive wave, which is the ideal wave to be trading, you're going to know it very, very quickly. As a quick refresher, impulsive waves are those moves in the market that are big, they're large, they're extended, and it makes trading feel so easy. If only trading could be like this every single time, and I'm sure you know exactly the kind of move I'm talking about. Corrective patterns, on the other hand, are choppy, they're sloppy, they take a lot of time to complete. And here's the kicker. The market is almost always trading in a corrective mode. So if you're looking at a price chart, odds are that you're not looking at an unfolding impulse wave, you're looking at an unfolding corrective pattern. And this is where folks get themselves in trouble. They pull the trigger while the corrective pattern is not yet complete. So I say this all the time, patience pays, right? It's like Rob says, we're hunting big game. We're not interested in capturing, the little squiggles and wiggles of a zigzag, as you're about to see. We're interested in capturing the impulse wave. So once a zigzag completes, it's going to be followed almost always by an impulsive wave. And that's why understanding the nuances and the ins and outs of the zigzag is so important. So let's get right into it. Okay, so the zigzag always subdivides into three waves, and here you can see we have two idealized line diagrams, one of a zigzag taking place in a bull market, and the other a zigzag taking place in a bear market. So the three waves of a zigzag are labeled using letters A, B, and C. Okay, so wave A will almost always take the shape of an impulsive wave. So it tricks traders into thinking there's a massive bear market coming. And, if you do look at wave A of a zigzag, it is possible to trade for wave C, because wave C also almost always takes the shape of an impulsive wave. But here's the thing, if you're trading for wave C of a zigzag, do not overstay your welcome, because once wave C ends, you will get a violent reversal in the other direction. Now here's a key point with zigzags. Wave B will never make a new price extreme beyond the start of wave A. Well, what does that mean? Let's take a look at this B wave of this zigzag right here. Notice that wave B ends below the start of wave A. So if it went above the start of wave A, that would be considered a new price extreme and would invalidate the labeling of this pattern as a zigzag. Zigzags are considered sharp corrections, so they correct through price, not through time. Now here are some guidelines regarding zigzags. Wave A almost always subdivides into an impulse wave. We're going to take a look at some examples of another pattern shortly called the leading diagonal. Very easy to identify. And similar to wave A, wave C almost always subdivides into an impulse wave as well. It can also end as an ending diagonal, and we're going to take a look at those situations as well. A common relationship between waves A and C is for them to be equal in length. Another trick that's very handy in identifying a zigzag is that wave C often has a less steep slope than wave A. And finally, wave C is almost never truncated. What does that mean? It means that wave C will almost always go on to make a new price extreme below the end of wave A, and we're going to take a look at some examples of that in just a moment. Now, zigzags can usually be channeled using parallel lines by drawing a line from the start of wave A to the end of wave B, and then taking the parallel of that line to the end of wave A. And we're going to now take a look at all this theory and put it into practical application very shortly. So first off, we've got another idealized line diagram here for you. So you can see how wave A is an impulsive wave. We covered this last week. Impulsive waves unfold in a 5-wave sequence. Wave B, in this case, is its own zigzag, labeled A, B, and C. And wave C unfolds as its own impulse wave. So this is a very textbook zigzag. And notice the red parallel channel. I call this the corrective trend channel. So we start by drawing from the beginning of wave A down here. We connect that line to the end of wave B. We then take a parallel of that line to complete the corrective trend channel by anchoring that parallel line to the end of wave A. All right, here's a bear market zigzag. Now in this variation, wave A takes the form of a leading diagonal, which is a very fancy way of calling a chart pattern a wedge. So notice how if I draw trend lines from the ends of wave 1 and 3 and from the ends of wave 2 and 4, we get two lines that look like they're going to converge. In other words, they're going to come together at some point in the future. That is a hallmark characteristic of a leading diagonal, all right, or a falling wedge, as classical chart pattern analysts might call this formation. Wave B takes the shape of a triangle, right? Again, symmetrical triangle. We'll be covering triangles in much greater detail in the future, so don't worry about that for now. And in this case, wave C takes the shape of an impulse wave, right? So a leading diagonal for wave A, a triangle for wave B, and then an impulse wave for wave C. Okay, so pop quiz. What's wrong with the zigzag? We have 1, 2, 3, 4, 5 impulse wave for wave A. We have a big B wave for wave B, and then we have a steep wave C for wave B. And then wave C takes the shape of an ending diagonal, a rising wedge this time. Right? So in the last example, wave A was a leading diagonal, or otherwise known as a falling wedge. And in this case, wave C is a rising wedge or an ending diagonal. So again, notice how the trend lines connecting the points of 1 and 3 and 2 and 4 look like they will converge together in the future. Right? So ending diagonals, rising wedges are powerful reversal patterns, and we'll be covering those in greater detail in future video classes as well. But back to this pop quiz, what is wrong with the zigzag? Well, the answer is that wave B here made a new price extreme relative to wave A, violating one of the cardinal rules of a zigzag. So we can no longer consider this pattern to be a zigzag. It must be something else. And that's the power of the wave principle in a nutshell, is that it gives us context for understanding market movements. All right. I like to describe Elliott Wave theory like putting together a puzzle. You know, the wave principle, if you're looking at the market without Elliott waves, you know, it'd kind of be like trying to put together that ginormous 5,000 piece jigsaw puzzle without having any idea what the completed puzzle is supposed to look like. So you're just kind of scrambling around trying to make pieces fit. With the wave principle, however, it's kind of like a cheat code where you get to look at the box that the puzzle came in, so you know exactly what the finished product is supposed to look like. All right, so we're now moving on to some real world examples here. Now, again, this is a stock, Marathon Digital Holdings, but it doesn't matter. This could easily be a currency pair, and we'll be looking at some currency pairs. In fact, Zigzag, another advantage of Elliott Wave theory is that these same patterns unfold the same way across all market classes, all asset types. All right, so here wave A takes the shape of a standard impulse wave, 1, 2, 3, 4, 5. Wave B takes the shape of its own zigzag, labeled A, B, and C, and then wave C unfolds as a classic impulse wave as well, labeled 1, 2, 3, 4, and 5. Notice again the corrective trend channel, where we start the channel by taking a trend line from the start of wave A to the end of wave B. We then take a parallel of that line to the end of wave A. And you'll notice that wave C could not penetrate or pierce the lower end of this trend channel. That's a very common occurrence. Here we have a zigzag in the euro-yen currency pair, 4-hour chart, 4-hour time frame. So again, 5-wave impulse for wave A, 3-wave zigzag for wave B, and then a 5-wave impulse for wave C. And again, we have our corrective trend channel. Notice what happens after we bust out of that corrective trend channel, we get the large reversal. And then finally, here we have an example in Polkadot US dollar, so a cryptocurrency this time. I wanted to show this example because here we have a leading diagonal for wave 1 of wave A, and wave 5 of A takes the shape of an ending diagonal. Okay, so wave A unfolds as a classic impulse with two diagonal formations substituting for the subwaves of the impulse wave and waves 1 and wave 5. ABC is its own zigzag, and then wave C here, the final wave of the zigzag, is an ending diagonal, or otherwise known as a rising wedge. And again, notice what happens once we break out the bottom of that corrective price channel. We get that large reversal. So zigzags are very powerful, very simple, and highly effective chart patterns, and it's very well worth your while to come to grips with them because they can aid you tremendously in identifying counter-trend corrective price action. Also, this is not recommended by me and it's not in my trading plan, but if you wanted to trade for wave C of a zigzag because they so often unfold as an impulse wave, you absolutely can. So if you look at this example in Euro Yen, if you were trading, the end of wave B here, you would have gotten a nice move down for wave 2, and you could have captured a nice move down for wave 3 as well. So it is possible to trade for wave C of a zigzag, but because the entire structure is ultimately a counter trend movement, it's far more advisable, in my opinion, to wait for the zigzag to complete and then trade the ensuing resumption of the larger underlying trend. So I hope you enjoyed this video, this class. Quite a few traders have started to reach out to me with questions and labels on their own price charts. I love seeing that, and I definitely encourage it. So if you want to run something by me, or if you have any questions about how to possibly trade a zigzag, please just let me know. All right, everyone, take care, and I will see you on Thursday for the currency recap.